In 2002, federal agents walked into one of America's most beloved family businesses. They put handcuffs on an 80-year-old grandfather in front of cameras. The whole country watched, and the question everyone was asking was simple. How did a man who started a company with $300 end up stealing $3 billion from it? John Rigas grew up in Coudersport, Pennsylvania. Population 2,500 people. His parents were Greek immigrants. After serving in World War II, he came home with nothing but ambition. He started a movie theater. Then, in 1952, he saw something new on the horizon. Cable television, a technology that could carry TV signals into homes that regular antennas could not reach. In the hills of rural Pennsylvania, that was basically everyone. He borrowed $300. And he started Adelphia Communications. The name comes from the Greek word for brothers, because John built this company with his family. That detail is going to matter later. For the next 40 years, Adelphia grew quietly and steadily. Small cable franchise after small cable franchise, town after town, state after state. By the 90s, the cable television industry was exploding, and Adelphia was riding that wave. They went public. They started acquiring other cable companies aggressively. They expanded into broadband internet and digital cable. By 2001, Adelphia was the sixth largest cable company in the United States. 5 million subscribers, $5.6 billion in annual revenue. The Rigas family was worth billions. John appeared on business magazine covers, celebrated as a pioneer, a self-made man, a patriarch. The kind of chief executive that Wall Street loves to tell stories about. And the story was beautiful. A humble founder, $300 turned into $3 billion in value. A family company with real roots and real community ties. Analysts recommended the stock. Institutional investors piled in. Regular Americans bought shares because the story made sense. Why would anyone doubt it? Here is what was actually happening behind that beautiful story. The Rigas family had created a parallel set of private companies completely separate from the public Adelphia. These entities were controlled entirely by the family. No outside shareholders, no public oversight. Just the Rigases. Here is the trick. These private companies were borrowing billions of dollars using Adelphia's credit, Adelphia's balance sheet, Adelphia's reputation, Adelphia's name. But the debts never appeared in Adelphia's financial statements. Think of it like this. You and your neighbor share a credit card. You both owe the money, but when you show your finances to anyone, you only show your own expenses, your neighbor's debt, invisible. $2.3 billion, hidden. And what was that money used for? They built a private golf course in Pennsylvania. Cost to shareholders who had no idea they were paying for it, $12.8 million. The family bought luxury condominiums in Manhattan using company funds. They purchased hundreds of millions in personal stock using loans guaranteed by the company. They even bankrolled a professional hockey team. Meanwhile, the public numbers always looked good, because they made sure they did. Subscriber counts were inflated. Revenue figures were dressed up. Quarter after quarter, Adelphia met or beat Wall Street expectations. Investors were happy. The stock kept climbing. This is the psychology of this kind of fraud. It does not start as a master plan. It starts with a founder who built something real and then began believing the company was his. Personally, totally. That shareholder rights and corporate governance were technicalities that applied to other people. His sons, raised inside that same culture, followed exactly the same logic. For years, the system worked, but there is a problem with hiding billions of dollars in debt. Eventually, someone has to pay. By 2001, Adelphia was drowning. The acquisitions of the 90s had cost a fortune, and the telecom bubble was deflating. The private Rigas entities were in even worse shape. The family owed Adelphia $3.2 billion. The auditors at Deloitte started asking uncomfortable questions. They were seeing transactions that did not add up, money moving between Adelphia and these private family entities in ways that were impossible to explain cleanly. They delayed their sign-off on the financial statements. And then, on March 27, 2002, Adelphia released its quarterly earnings. Most investors read the headline numbers and moved on. But one financial analyst read every single word, including a footnote, a small technical paragraph buried deep in the document mentioning co-borrowing arrangements with entities affiliated with the Rigas family. $2.3 billion. 6 lines of fine print. The analyst started making calls. Other analysts started asking questions. Within days, the story was everywhere. The stock began to fall. Deloitte refused to certify the accounts. Creditors called in their loans. The facade was coming down. The stock went from $20 to under $1 in weeks. NASDAQ delisted Adelphia in June of 2002. On June 25th, the company filed for bankruptcy. $60 billion in shareholder value. Gone. 1 month later, John Rigas was arrested. His son Timothy was arrested. They were walked through the streets of Manhattan in handcuffs while cameras captured every second. An 80-year-old man who had built an empire from nothing, ending his career in a perp walk. In 2004, the jury came back. Guilty. Timothy received 20 years in federal prison. John received 15. Thousands of Adelphia employees lost their jobs when the company's assets were sold off to Comcast and Time Warner. Millions of ordinary investors who believed in the story lost their savings. John Rigas was released in 2016 on compassionate grounds. He was dying of cancer. The justice was imperfect, as it usually is. So what do you take away from this? Because this is not just a story about one greedy family. This is a story about traps that destroy investors over and over again. First, always read the footnotes. Adelphia technically disclosed $2.3 billion in hidden debt. It was in the fine print. Most people never read fine print, and fraudsters know this. Before investing in any company, search the filing specifically for the words related party transactions and off-balance sheet arrangements. If those sections are vague, that is not an accident. Second, family control without independent oversight is a structural red flag. Adelphia had a father as chief executive, his sons in senior leadership, and a board packed with people who owed their positions to the Rigas family. Nobody in that room was ever going to push back. When you evaluate a company, check how many board members are genuinely independent. Third, when a company never misses its targets, ask why. Adelphia consistently beat Wall Street estimates for years in a volatile, capital-intensive industry. Real businesses have bad quarters. If a company's results are always exactly as promised, someone might be managing the numbers more than the business. And finally, for anyone building a company, the moment you take outside money, the company is no longer fully yours. Taking a public company's money for personal use is not a founder's privilege. It is fraud. Build the financial separation between yourself and your company from day one, regardless of how much you own. The next fraud will not look like Adelphia. It never looks the same twice, but the red flags, those never change. Every week, a new billion-dollar lie gets exposed on this channel. Subscribe so you do not miss the next fall from grace. And if you spotted the warning signs in this story before the collapse, drop a like. It means you are already thinking like an investigator.